Hello, my name is Sheila Macharia. I'm a researcher at Capital Investment Bank. I'll be taking you through some of the macroeconomic factors that affected Kenya's economy in the month of March. Well, the economy has remained resilient, and we can look into various factors as to why I say this. First, the Kenyan shilling has remained stable at 129 against the US dollar since August 2024. This stability has helped reduce pressure on imports and also businesses that are reliant on foreign exchange. In regards to the forex reserves, they have increased to $9.9 billion as of 27th March, that was Thursday last week, which is equivalent to 5.1 months of import cover. And this is a positive sign as it boosts investor confidence in Kenya's ability to meet its external obligations. In regards to the private sector, we anticipate growth following the recent rate cuts to 10.75% in the month of February, which is expected to boost business activity. However, we are still waiting for the latest PMI report so that we can get a clearer picture on this. We have seen fuel prices remain relatively unchanged in the better parts of 2025, with petrol retailing at 176 shillings, diesel at 167, and kerosene at 151 shillings in Nairobi. This stability has been maintained despite global oil fluctuations, thanks to the government-to-government oil deals and also EPRA's price policies, which have supported economic recovery, keeping inflation low and strengthening the Kenyan shilling. On the other hand, we saw a slight increase in inflation in the month of March, where it rose to 3.6% from 3.5% that was recorded in February. We attribute this increase to increase in food prices, particularly sukuma wikis and potatoes. We also saw a slight increase in electricity prices and also in gas prices. In regards to tax collection, the government has collected 1.4 trillion in tax revenues in this fiscal year, compared to 1.37 trillion it collected last year in the same period. However, it still needs to raise 1.07 trillion the next 4 months so as to meet its target and prevent any widening of the fiscal deficit. This shortfall threatens the recurrent expenditure of 2.1 trillion Kenya shillings, which covers salaries, debt servicing, and also operational costs. Additionally, it cuts its development spending, which has weakened economic activity and also reduced tax inflows. So for KRA to meet its revenue targets and avoid any fiscal crisis, it needs to broaden its economic recovery measures and expansionary policy shift. When it comes to the Eurobond space, at the beginning of March, the Eurobond yields declined following a positive S&P credit rating of Kenya. However, yields started rising after Kenya's 2027 Eurobond buyback and also the announcement of the IMF backstop its lending programs with Kenya. In our view, this signals rising investor concerns over Kenya's debt management. In regards to our economic outlook for Q2, we anticipate the economy to continue being resilient. We await for a softening inflation, particularly in food inflation, as we look forward to strong agricultural output supported by the favorable rains we're experiencing right now. Additionally, a stable shilling should help reduce import-driven inflation. We also anticipate growth in the private sector as the economy responds to the February rate. That's all for today. See you next time.
Partner with CAIB to build a legacy that lasts.